I think, guys, one stock that we need to look at is the HDFC Bank as well, because, Heyman had a conversation with regards to RIL and the way Nifty has been moving. But HDFC Bank also is one of the contributors to Nifty 50 today.
Yeah, take a look at that chart. It's on the screen right now, 2.5% at very close to the high point of the day, and over 70 points currently being contributed.
35,000 crores in market cap.
That's huge.
Only one stock contributing over 70 points to the Nifty 50 in today's trade. But let's bring on Parag Thakkar, who's head fund manager at Fort Capital, because he often speaks about HDFC Bank, and in the context of having reached where we are in the interest rate cycle and the relative valuations of banks right now. Parag bhai, thanks so much for taking the time. What are the factors, according to you, that would support an up move for an HDFC Bank right now? Fundamentally, does it still look like a very strong candidate?
It's a no-brainer. It's the highest weight in my portfolio and the most undervalued stock in Indian large cap basket, I would say. And the reason is follows. That, for example, it has across the cycle, it has proven that the asset quality is the best amongst all the banks. Deposit franchise is very solid. Cost of funds is lowest at 4.5%. These are the key ingredients for making a successful bank. First of all, asset quality has to be fantastic across the cycles, I would say, not only last 3-4 years, but across the cycles, because that speaks about the prudent lending and underwriting practices that they have. And I would expect that given that RBI stands on liquidity, they have managed to keep 2.5 lakh crore surplus liquidity in the banking system. Plus, they are not overly concerned about CD ratio. So I am 100% confident that HDFC Bank will be able to meet its guidance on CD ratio also, and growth also, loan book growth also, that they'll grow in line with the system in this quarter for FY26, and FY27 they'll outgrow the system comfortably with stable to positive margins and robust asset quality. And I would say the valuations are very, very comfortable. If you see FY28, the book value of core banking book value is 460 rupees, and core banking EPS is around 65 rupees. So on PEG and ROA by price to book also, it looks very, very comfortable. PE is just 13x for above 16% EPS growth, and price to book is just 1.8x for ROA of 1.8 to 2%. So I think it is a no-brainer. It is a most undervalued stock in the market in my view.
Okay, Parag bhai, the most undervalued stock is what you're looking at, a no-brainer in terms of whether you should buy or what you should do. What is that first target price that you're staring at? Because I'm sure investors are waiting out to understand what should they look at.
See, I'll tell you, basically, if a bank makes 1.9% ROA and grows at 16% in terms of EPS, you should assign minimum 17-18 PE on that 65 rupees EPS, or you can say 2 times price to book on 460 rupees plus 130 rupees subsidy. So minimum, most conservatively, one can look at 1,050, and on a base case scenario, it can be 1,150 to 1,250 also, because generally HDFC Bank has always got 2.5 times price to book. So if you apply 4.460 into 2.5 plus 130, which is a subsidiary value, it comes to closer to around 1,200 rupees.